Good morning, Facebook, and welcome to another edition of Advisory Live. I'm Alan Schoenberg with Nasdaq. Joining me is our advisory analyst, Masood Gauzi. Welcome, Masood.
Hi, Alan. How are you?
Good, good. We've got a lot of great topics to talk about. We're going to talk about politics today. We're going to talk about corporate bonds. We're going to talk about passive and quant investing. Let's start out with politics, though. A lot going on in D.C., particularly around healthcare. A lot going on with some of the midterm elections, special elections that are happening. How is that impacting the markets?
Yeah, Alan, so there's a lot of noise, political noise in the markets. If you kind of read the papers, it seems to be a lot of gloom. But interestingly enough, the markets have been holding up pretty well. Last week, we saw a sell-off. Markets were slightly nervous. Some Republicans claim that the Trump administration should tone down some of the drama coming out from Washington. But however, markets have been hitting new highs. The Nasdaq Composite is up 14% on a year-to-date basis. The S&P 500 up 7%. The Dow Jones is up about 6%, and the Russell is up. Russell 2000 is up about 2%. And this is happening despite the fact that the Fed is looking to tighten monetary policy in terms of raising rates. The implication in all this is the current recent rally is being fueled by a lot of tech names, large caps, and small mid caps are underperforming.
Okay, so you mentioned the Fed. Let's go back to the last time we had our discussion. We talked about there's the potential for 3 rate hikes this year. We've got the notes from yesterday's meeting. What do you make of it?
Yeah, so yesterday we got the Fed meeting notes. Basically, the takeaway there was that we're looking at another rate hike in June. The odds of that are extremely high, so we should see a rate hike. What's being called into question is the 3rd rate hike this year. The market's pricing it at 1.44 times. 1.44 more rate hikes this year. So that's primarily a function of investors getting nervous about whether the markets can hold up and the pro-growth policies passing through Congress. We're looking at Treasury yields trading in and around 2.2 to 2.4%. It's been yields have been coming down over the last 2 days. And that's because everything has been priced into the markets. And finally, the Fed talked about trimming their balance sheet.
Okay, so we talked about Treasury yields. You just mentioned that. How is that playing into the bond market, particularly high yields, as well as I'd like to hear your thoughts on the corporate bond market?
Yeah, sure. So it's interesting because if we look at the high yield corporate bond ETF, it's at levels not seen since 2015. Yields are aggressively, and this is the riskiest part of the corporate debt market, the junk bonds, high yield. They're tightening quite aggressively. If we look at the Bank of America high yield index for the US, it's approaching 5%. The European ones are approaching 2%, and this is at historic lows. If you compare corporate debt from 2 decades ago, it's up 275% at $8.5 trillion. So a big surge in corporate debt. However, the good news is that leverage ratios and leverage metrics, debt service ratios, are coming off of their peaks. The negative news is that the quality of debt is deteriorating. Back in 1996, 2/3 of corporate debt were investment grade. Now currently less than 45% is investment grade. So at a high level, the takeaway, yields are coming down, issuance is robust, service ratios are solid, but having said that, the quality of debt has been deteriorating.
Okay, last question for you. I know you read the story, a great one in the Wall Street Journal this week on quant investing, the continued increase in passive investing, particularly around ETFs. Let's talk about that trend for a little bit, because I would really like to know your views on where we're seeing this world go, and maybe you could talk a little bit about what quant investing is.
Sure, absolutely. So passive index money, your BlackRocks of the world, Vanguards of the world, this has been talked about for a while now. They're significantly gaining market share at the expense of active investors. What's interesting is quantitative investing, quantitative in a nutshell, meaning computers trading, essentially people, engineers building algorithms and having machines trading, usually a much shorter time span, everything from nanosecond to couple-day holding period. This part of the market is seeing explosive growth. With respect to quant funds, 27% of the current market activity is purely driven by quant funds. Back in 2013, it was about 14%. Retail investors are in and around 29%, so quant investing is approaching the levels that retail investors are trading at. In terms of assets under management, in Q1 we saw $932 billion of quant money being managed. This is 30% of all hedge funds, and compare that to 2009, in which we had $408 billion of assets under management, which was about 25% of all hedge funds. So essentially, quant investing, their size, assets under management over the last 8-9 years, has more than doubled.
All right. Well, as always, your insights are incredibly valuable.
Oh, thank you.
Thank you so much. I want to thank everybody for joining us again for another edition of Advisory Live. Join us next week. If you're looking for more information, you can go to business.nasdaq.com. Look at our blog, Market Insight. Always daily updates there for everybody about what's happening in the marketplace. Thank you again, and we'll see you next week.